Okay, guys, so welcome to this ACCA SBR Revision Marathon session for the September 2023 examination session. Um, my name is Luqman Rafiq, and I shall be taking you people through this specific SBR Revision Marathon session. Before I proceed, let me just guide you people a bit about myself and a bit about what we would be doing in this specific session. So first of all, about myself, I have been in teaching profession for more than 13 years now, and I've been teaching different qualifications, including the ACCA, the ICAW, the ICAP of Pakistan, and some other qualifications. Plus, I've been teaching different subjects, including the financial reporting, including the financial management, performance management, and auditing. There have been different subjects that I've been teaching over a period of time. The whole objective and the whole agenda of the session of today is that we want to make sure that we go through the maximum exam practice questions on the ACCA SBR, and I take you through these examination questions, revise the different concepts that are involved, and then we actually try to attempt these questions on the Excel. I won't be using the ACCA CB practice platform. The reason for me not using the CB practice platform is that unfortunately, when you use the CB platform, you just cannot save the answers to the questions in the Excel format. So just to ensure that I'm able to share the handouts with you, I'm able to share the workings with you, I'll just make sure that I do it on the Excel so that I could share the solutions and that you could actually benefit out of those solutions. So for those of you who are actually part and parcel of the session, what I would actually do is that there is a WhatsApp community that I have for the ACCA SBR. What I'll be doing is that I'll be sharing the link to that community with you people, so that if any one of you would like to join in, they could just join in. The handouts have also been shared onto that community. Plus, this video is right now being live streamed onto Facebook, live streamed onto the this is being live streamed onto the WhatsApp, everywhere this is being live streamed onto, right? So just for the sake of you people getting to know, because a lot of students, they come and ask the question that would I be getting the recording? Ideally speaking, if you don't go for the recording, but rather continue this live session with us, that actually helps you. But just in case if you are stuck somewhere, or if you have got some commitments, or if you've got some issues, then obviously you could just go for the recordings and you could review. Now, when you are live, the advantage of you being live with us is that you can ask the question on a regular basis and you could just get your answers to the questions then and there. But it's still, again, I mean, like, I do understand that a lot of students, they've got their own commitments. The time may not be suitable for many. So there could be multiple things that could happen. So just in case, if you're not able to join in live, you could watch the section, you could watch the lectures later on at your own convenience. We would be just making it available for you people. So before I start off, if any one of you have got any questions, you are most welcome to ask those questions. I'll be happy to answer them. So just in case if you have got any questions to ask, just let me know. I'll be happy to answer them. Yeah, just in case if any one of you would like to ask anything, you are most welcome to ask. I will be happy to answer before I proceed, and I could just go on with my own thing. My voice is breaking. Is it still breaking, Ijaz Ahmed? Is this the issue with everyone in here, that my voice is breaking? Is this the issue with everyone here? Yeah, is this an issue with everyone that my voice is breaking? Okay, lovely. Good enough. So let me just start off and let me just take you people through. Okay, I have just taken out a few questions with for the session of today, and I'm gonna start going through those questions so that you people could actually have an idea that how to solve those questions. The first question that I have in front of me is basically one of the questions from the recent examination. I've taken out some handouts, some extracts from the Kaplan kit. So the first one that I have with me is actually the question which is named Sterling Company. I repeat, the first question that I have is the name of the question is Sterling Company. So I'm actually going to take you people through this Sterling Company question, and we're going to start discussing that what is there with respect to Sterling Company. Again, as I told you that I shall be doing this question on the CB, not on the CB platform, but rather I would be going through the question through the Excel so that you people have an idea that how to handle these questions. So let's just start off, let's just start discussing. This is one of the question, the name of which is Sterling Company. Obviously, the question is not molded according to the new format. The new format is that you would have a pre-prepared sheet, the Excel sheet, where you would have to actually prepare either a trial balance completion or maybe income statement completion or maybe the balance sheet completion, things like that. So let's just start off, let's just start discussing. It says Sterling Company is currently, I repeat, Sterling Company is currently preparing its financial statement. What does it say? It says Sterling Company is currently preparing its individual and consolidated financial statement for the year ended 31st March 2009. So you're preparing individual and consolidated financial statement for 31st March 2009. Now what else is there? It says the following exhibits available below provide information relevant to the question. Now, what is the information that is being provided? It says acquisition of Berthold Company. Now, what is this acquisition of Berthold Company? It says this describes the purchase of 40% of the Berthold Company on 1st January 2007 and a further acquisition of 35% on 1st December X8. So 1st January X7, 31st December, 1st December X8, this is how the acquisitions have taken place. Then it talks about investment in malting company. Investment in malting company describes the purchase of 30% of malting company on 1st July 8. So on 1st July 8, there is a 30% acquisition of malting company. Then batch company, which is a discontinued operation. I'll just go about discussing few things. Describes the acquisition of batch company, that is Sterling Company decides to sell on 1st January X9. The information should be used to answer the question requirement within your chosen response option. Now, before I go on to discuss this, I would talk about the questions requirement so that I'm able to connect that what are we required to do actually. Now it says using exhibit number one, explain how Berthold Company will be accounted for, including the calculations in the Sterling Company's consolidated statement of profit or loss for the year ended 31st March 2009, and explain and show how the goodwill in Berthold Company would be calculated at 1st December 8. So it's a 8 plus 6, 14 mark requirement. What is it? It is actually a 14 mark requirement. So what do we need to do? We need to actually discuss about this 14 mark requirement, and we need to solve the things that how exactly are these things gonna be accounted for. Now, first of all, if I go on discussing about this Berthold Company, I would want to actually start discussing uh, I would want to start discussing about few things so that I can take you people through. Okay, let's just start off. So basically, with respect to this Sterling Company, with respect to this Berthold Company, let's try to understand few things before we start doing this scenario. Now, you know this thing that when we talk about the investments, So there are different categorization, different classifications for the investments. So when I talk about the different classifications for the investment, so one of the classification is that of an associate. The other classification is that of a subsidiary. When we talk about an associate, when we talk about a subsidiary, so what exactly are the differences? So when I talk about the associate, what is an associate? An entity, an entity upon which significant influence is exercised. So it's an entity upon which significant influence is exercised. So when we talk about, I repeat, when we talk about the concept of this sterling company, the first thing is that you need to understand that associate is an entity upon which significant influence is exercised. Now, when I talk about the concept of significant influence, there is something that you need to understand. And what is it that you need to understand with respect to significant influence? The significant influence is actually, when we talk about the significant influence is actually the power to participate in decision making. So we know this thing that when we talk about the power to participate in decision making, this power to participate in decision making, how does it arise? This power to participate in decision making actually arises through how? It's basically like this. It's actually through BOD representation. This is through BOD representation. And when we have got an associate where we exercise the significant influence, what we do with respect to associate is that we account for the associate using equity method of accounting. I repeat, for what we do is that we account for the associate using equity method of accounting. I'll just go about discussing the equity method of accounting also, but before that, let's have a quick recall of the basic concepts. Now, similarly, when we talk about a subsidiary, so you know this thing, that what is a subsidiary? A subsidiary is an entity upon which investor exercises control. So a subsidiary is an entity upon which the investor exercises the control. So I repeat, entity upon which the investor exercises the control is actually going to be subsidiary. And when we talk about the control is basically have a certain definition, which obviously we're going to come back again when we are going to be discussing it again. So the entity upon which the investor exercises control is going to be a subsidiary. And we know what do we do with respect to subsidiary is that we actually consolidate subsidiary. We actually consolidate subsidiary. Now, if I talk about the concept of this equity method of accounting, let me just give you a bit. So when we talk about this equity method of accounting, how do we go about with the equity method of accounting? So with respect to the equity method of accounting, what we do is that there is a separate accounting with respect to the SOFP and there is a separate accounting with respect to associate. With respect to SOFP, what do we do with respect to SOFP? With respect to SOFP, we actually present a single line item. What do we do? We actually present a single line item as investment in associate. So I repeat, when we talk about the equity method of accounting, what do? We present a single line item and that single line item is shown as investment in associate. That's the first thing, which is investment in associate. Now, how do we show this investment in associate? So this investment in associate is being shown like that. What do? We say cost of investment. After the cost of investment, what we do is that we add up share of post acquisition reserves. So whatever the post acquisition reserves of the associate, you simply add them up. How do we add them up? Let's say, for example, if you have got 30% shareholding, so you'd simply say that 30% current net assets minus acquisition date net assets multiply by this, so you resultingly end up getting the investment in associate. And what we do is that with respect to this investment in associate, this figure is shown in the SOFP. This figure is shown in the SOFP, the investment in associate. Similarly, if I talk about the statement of comprehensive income, so with respect to statement of comprehensive income, what happens is that, let's just try to understand this. With respect to statement of comprehensive income, again, for the statement of comprehensive income, what we do is that we present, okay, just a second, some of the students are complaining that the screen is quite blurry. I have got I've got the Zoom screen open in front of me, and it's perfectly fine with me. So when it's perfectly fine with me, so it should be fine with almost everybody here. The reason being that I'm also using, I'm also being connected on the Zoom through another screen. So it should be same. It should be clear with everyone. Is it? Is it clear with everyone? Yeah. Can you people just confirm? Can one or two more confirm that if it is clear with you people? Okay. Then I'm sorry, those who are having this blurred screen, please just try to reconnect your internet or maybe change your internet or something. Okay, so again, what happens is that with respect to statement of comprehensive income, what we do is that we present a single line item. What is that single line item going to be? That single line item is going to be, you would show the share of profit from associate, share of profit from associate. So whatever the profit after tax is, let's say if you've got 30% holding, so whatever the post acquisition profit after tax, you multiply with that and you actually apply it. So that's a single line item that you show with respect to statement of comprehensive income also. So whenever we have an equity method of accounting, that's how we do it. Now let's move a bit forward and let's talk a bit further. The next situation that I want to discuss before I go on to talk about the Sterling company is that I want to talk about the situation of step acquisition. Now, obviously, there are multiple scenarios with respect to step acquisition. What I'm going to be discussing now is what is prevalent in this specific situation. So when I talk about the concept of a step acquisition, the step acquisition is when you acquire a company in different steps, different stages. That's what is considered to be a step acquisition. Now, generally speaking, what happens is that the step acquisition could be like this. You have a 5% shareholding, you go on to 70% shareholding. You have a 25% shareholding, you go on to 70% shareholding. You have a 50% shareholding, or let's say 55% shareholding, and you go on to 70% shareholding. So the step acquisition could actually be different types. Now when I talk about the step acquisitions being 5 to 70, 25 to 70, 55 to 70, so what's happening? Here it's actually a simple investment under the IFRS 9. It's simple investment under IFRS 9 and it's becoming a subsidiary under IFRS 10. It's an associate under IAS 28 and it's becoming a subsidiary under IFRS 10. It was a subsidiary under IFRS 10 and it's a subsidiary under IFRS 10. So basically there are three different type of scenarios: an investment converting into a subsidiary, an associate converting into a subsidiary, a subsidiary in which your shareholding is increasing. So all three type of acquisitions are being dealt in a different manner. I'll just take you people through that how exactly would you deal with all of these situations before I go on to examination scenario, because right now in this scenario this is the case which is available. So I'm just going to talk about this case and then we are going to take things forward. So for example, if you have got an investment where you had an associate, and from associate if you are becoming a subsidiary, I bet you had a company which was an associate, and from associate it is actually becoming a subsidiary. So what is it that you have to do? Just try to understand. You have to remeasure existing. You have to remeasure the existing investment to fair value. Any gains or loss to be recognized in profit and loss account, right? So you have to remeasure the existing investment to fair value. Any gain or loss shall be taken to P&L. That's what you would have to do. Now let's discuss a bit further. Let's talk a bit further about it. The next situation that you need to understand is that I've just told you that associate to subsidiary, what you have to do. So when we talk about the existing investment to fair value, what is the existing investment that we would be remeasuring? So it's actually the existing investment is going to be your investment in associate. So whatever the carrying amount of associate that you have, you would be actually remeasuring it to fair value. Gain loss would be taken to P&L. Now there is one more thing I want you people to understand, which is when we talk about when we talk about individual financial statement, when we talk about the group financial statement, I repeat, you talk about individual financial statement, you talk about group financial statement. There is a different method of recognizing the gain or loss, because you see, in the individual financial statement, you have a choice that you could be measuring your investment. You have a choice, you could be measuring your investment at cost, or at fair value through P&L, or at fair value through OCI, or using equity method of accounting. You have a choice. But with respect to the group financial statement, generally speaking, what we do is that we measure the investment in associate using the equity method of accounting. I repeat, we measure the investment in associate using the equity method of accounting. So let's say in the individual financial statement, if the investment in associate is carried at cost, and if in the group financial statement it's being carried using equity method of accounting, then obviously there is going to be a difference. I repeat, then obviously there is going to be a difference, and we need to be considering we need to consider that difference accordingly, right? So there has to be a difference and you would have to consider that. Now let's just start off and let's just start discussing things about this specific situation so that we could move forward. This was the question, the name of which was Sterling Company, and the first scenario is about Bird Hold Company. Now, what is it? It's actually about Bird Hold Company. So just to make sure that I'm able to give this a picture in a single page to you people, I could just go on to paste it here so that we could see the whole scenario in front of us on a single page rather than going here and there, right? Okay, I think it's very clear now. Just one thing, basically we are trying to solve the question for the year ended 31st March 2009. What are we trying to do? We are trying to do it for 31st March 2009. There are two requirements. One of them is how it would be recorded in consolidated P&L, and the second thing is that how goodwill in Berthold should be calculated at 1st December 8. That's what we have to do. So let's just start off. Let's just start discussing. When you talk about 31st March X9. That means we are talking about 1st April X8. 31st March X9, you're talking about 1st April X8. 1st April X8. यूट्यूब पे जा रहा है, मुझे नजर नहीं आ रहा. जी. नजर नहीं आ रहा है, किस पे जा रहा है ये? स्क्राइबर एकेडमी पे. यार इसकी जो है ना वो सेटिंग चेंज करनी पड़ेगी पावर की. ये बार बार जो है ना वो स्लीप मोड पे चले जाता है. क्या करूं? स्क्रीन एंड स्लीप. नहीं बताया. वहां से देख लो, अगर कर सकते हो तो कर लो. प्राइवेट में जा रही है ना, प्राइवेसी. क्या बता. Okay, so um, let's go through this specific scenario. It says Sterling company paid $25 million for 40% of Berthold company's 10 million $1 ordinary shares on 1st January 7. So what did they do? They paid 25 million for 40% of the 10 million ordinary shares. So if I talk about this Berthold company, so number of shares acquired is 40% into $10 million, 10 million shares. The cost was $25 million when Berthold company's retained earnings were $18 million. Next, it says Berthold company has no other reserves. Sterling company exercised significant influence over Berthold's financial and operating policy decisions. A further 35% stake was acquired on 1st December 8 for $41 million. 1st December X8 additional shareholding, which is 35%, was acquired. The cost that you paid was $41 million. The cost that you paid was $41 million. Now, it says that when the fair value of identifiable net assets was $55.3 million. And Berthold retained earnings were $42.3 million. Then it says the difference between the fair value of identifiable net assets and liability and carrying amount related to non-depreciable land. So any fair value adjustment that was there, that was pertaining to the non-depreciable land. The market price of the shares immediately prior to 1st December 8 was 9.2 per share. Sterling measures NCI at fair value. At the date of acquisition, goodwill is not impaired. Berthold Company reported a profit for the year ended 31st March 9 of $11.1 million. So what did they do? They reported a profit for the year ended 31st March 9 of $11.1 million. Now just try to create a picture of what is going to happen with respect to Berthold Company. So I'm just going to create a picture for you people, then I'm going to solve it all. First thing is that 1st April X8 till 31st March X9, this is the period. 1st April X8 till 31st March X9, this is the period, right? So this is the period. Now what actually happens is that 1st December X8 is the date when you have acquired additional shareholding. So for this period, it was an associate. For this period, it was a subsidiary. So there is a period for which it's an associate. There is a period for which it's a subsidiary. This date of 1st December 8 is actually the date when the additional acquisition took place. So what actually happens is that for this specific period, you will apply equity accounting. At this date of 1st December X8, you would be calculating goodwill. For this period of 1st December till 31st March 9, you would actually be doing the consolidation. You would actually be doing the consolidation. So that's how things are. You'd be applying equity accounting, you'd be doing goodwill calculation, you'd be doing consolidation. That's how things are gonna be. Now, so this is in general that you have to do with respect to it. Now let's start discussing and let's just start looking at things that what are the things, how exactly are we going to do the accounting, etc., etc. So every single thing that's relevant, we are going to discuss that now. Okay, so if I talk about the Sterling company, if I talk about the Sterling company, I hope that you people have the handout. I've already shared with you people the WhatsApp link, and I hope that you people have the handout so that I've shared with you people the link for this specific WhatsApp community. So just in case if you want to know if you want to look at okay, so for the Sterling company, what is actually happening is that the first thing that you need to do with respect to Sterling company is that you need to calculate the investment in associate as at 1st December 2000 x8, because you see what actually happens is that um, as at 1st December x8 you would have to do some consolidation. Let me just show you what was the requirement of the question. See, the requirement of the question was explain how Berthold company will be accounted for, including calculation is Sterling company consolidated profit or loss for the year ended 31st March x9, right? That's what they are asking you for, and that's what we are gonna show them. But let me just do some calculations, then I'll just open up a Word file also, so that I could draft out the relevant answers for you people, so that you could just see that okay, what's the answer going to be. In fact, I could have even drafted out the answer in the spreadsheet also, but anyways, I mean, like, good and better to do it on the Word. Okay, see, investment and associate as at 1st December 2000 x8. So if I talk about the investment and associate, you would say the cost of investment. We knew the cost of investment was $25 million. Add share of post acquisition profits. The 40% multiply by the profit. Uh, okay, let's say at first reserves at 1st December x8, reserves at acquisition date. So if I talk about all of this, what is actually going to happen? Try to understand this. Reserves at acquisition date, we know it from the scenario that the reserves at acquisition date were what? Uh, we were just being told that the retained earnings were 18 million. What else were we being told? We were being told that at this acquisition date, the reserves were zero. There were no other reserves. So in fact, what I would say is that net assets at 1st December and net assets at acquisition date. So when you talk about this, the net assets at acquisition date is that share capital, retained earnings. 10 million was the share capital. The retained earning was 18 million. Hence, resultingly, it was 28 million, right? How much was it? It was 28 million. That's one thing, right? Let's talk about the second one. The second one is basically share capital, that is 10 again. Uh, so you've got share capital, which was 10 again. How much was the retained earning? Retained earnings was 42.3. Hence, this is going to be 52.3. So you would have this 52.3. Now let's just have a bit of a discussion about all this. Okay, so 24.3 is the post acquisition reserves, share of investment share in this associate was 40%, right? So basically, you would say this multiplied by 40%. Hence, what would happen is that this is the investment in associate at 1st December X8. This is an investment in associate at 1st December X8. Right? So, the investment in associate at 1st December X8 was established at 34.72. We have been given the task of performing the accounting for the whole year ended, right? So we'll do some calculations. I would do all the calculations and then I would just connect it. This is for part A. In fact, this is for part A1. Let's talk about for part A2. What is the requirement for part A2? It says explain and show how the goodwill in Berthold company would be calculated at 1st December X8, because up till 1st December X8 it was an associate and now it has actually become your subsidiary. So how the goodwill should be calculated, let's have a bit of a discussion about goodwill calculation also. So you would say, first of all, the remeasurement of existing investment of 40%. How would you do that? You would say fair value of investment at additional acquisition date. How much is the fair value of the investment at additional acquisition date? So additional acquisition was done at 35%. The amount that you paid was 41 million. Fair value of net assets was this. Let's just do this fair value. We do have a fair value estimate also. We were being told, I think, something like that. The market price of Berthold shares immediately prior to acquisition was this 9.2. So if it is like this, you would simply say 40% multiplied by 10 million shares multiplied by $9.2. So it's actually what? It's actually 40% the original holding multiplied by 10 million shares multiplied by 9.2, which is the market value of each share. So 36.8 carrying amount of existing investment. How would you get the carrying amount of the existing investment? That is going to be on the basis of investment in associate at 1st December X8. So that was 34.72. So 2.08 is basically the gain in fair value. What would you do? You would be recognize this in P&L. This should be recognized in P&L, right? What it should be done is that it should be recognized in the P&L. Now, what next is there? So we have now discussed one aspect, which is the associate. We have discussed the second aspect, which is remeasurement. Now we need to talk about again A2, the goodwill calculation for investment in subsidiary. How is it going to happen? You would say the fair value of existing interest, which is 36.8, cost of additional acquisition, was 41. The non-controlling interest, which we will calculate, it's actually, since now you have got 35 plus 40, 75%. So it's actually going to be 25% multiplied by 10 million multiplied by 9.2, right? So that's actually 25% multiplied by 10 million multiplied by 9.2. Less fair value of identifiable net assets. Share, okay. We were being told some fair value, I think so. Okay, since we have to establish the fair value adjustment of land also, I'll just go about doing the calculation like this. I would say share capital. I would say retained earnings. The other reserves term to be 0. Fair value adjustment for land. So it's actually gonna be 10 million. Retained earning is 42.3 million. The total fair value was 55.3 million. So hence this is going to be this minus 3 million. So this is what the goodwill is going to be, 45.5. So I bet this is what the goodwill is gonna be, 45.5. Now what we need to do is that we need to actually discuss how the accounting would be done. Okay, one more calculation that is required to be done is that basically the share of current year's post acquisition, okay, post acquisition profit for the current year is going to be 11.1 multiplied by 4 divided by 12. 3.7 million. 3.7 million. Now let's just start off. How would we go about discussing the accounting for this sterling company? The Berthold company, the investment in Berthold company of 40% provides significant influence over Berthold company to sterling, and hence the investment shall be classified as associate. In the statement of comprehensive income for year ended 31st March 2009, the Berthold, the share of profit of Berthold for the first 8 months period till 30th November 2008 shall be presented as a single line item as income from associate. The amount to be shown shall be 11.1 million multiplied by 8 divided by 12 multiplied by 40% is equivalent to $2.96 million. $2.96 million. Once the investment in Okay, let me just go back to the requirement of the question again. For the period from 1st December 2008 till the end of the year, that is 31st March 2009, the investment in Berthold has become a subsidiary and shall be consolidated in the financial statements. And shall be consolidated in the financial statement, right? Now, what next is there? At the date of further acquisition, the goodwill, okay, the existing investment of 40% shall be remeasured to fair value as per the spreadsheet, and the gain of dollar, right? Okay, now let's move on to discuss the next aspect of the question, which says explain and show how the goodwill in Berthold company would be calculated at 1st December 8. With respect to the goodwill calculation, the existing interest of 40% at its fair value and the cost of additional acquisition of 35% shall be considered as the cost of investment for the purposes of goodwill calculation. The fair value of $9.2 per share of Berthold shall be used for the estimation of the fair value of NCI and the existing interest. The fair value of net assets are available, and on the basis of the available information, the balancing figure of $3 million shall be considered as the fair value of the land. The goodwill is estimated to be $45.5 million. The goodwill is estimated to be $45.50 million as per the spreadsheet. So this is how you're actually going to answer this question. So we are done with this specific part of the question, A1 and A2. If any one of you have got any questions still here, do let me know, or else I'm going to move forward now. Yeah, is everyone okay till now? Okay, we're going to take a short break for prayers. The time right now is 7:20 p.m. over here in Pakistan. I don't know the different time zones, so I'll just take a prayers break till 7:35 p.m. Pakistan time. So I'll just take the prayers break till 7:35 p.m. Pakistan time. I'll catch you people again at 7:35 p.m. Welcome back. So we are back from the prayers break, and I'm just gonna continue now and take things forward. So up till now, what have we been discussing? We have been discussing about this specific scenario. The question's name is a Sterling Company. We are going through the different aspects of this Sterling Company. Let's start discussing about the other aspects of the questions, and let's take things forward. So now the next aspect of the question is basically, let's discuss. It says using exhibit number 2, advise the directors of a Sterling Company with illustrative calculations how 30% investment in malting company should be accounted for in a Sterling Company's individual and consolidated financial statement. So you have to actually advise them that how the 30% investment should be accounted for in the individual financial statement and in the consolidated financial statement. Now, what is this malting company all about? Let's go through it. Let's try to discuss this. It says investment in malting company. What is it? Investment in malting company. says on 1st July 2008, Sterling Company paid cash of $2.5 million and issued loan notes with a nominal value of 1.1 million and a fair value of 1.3 million dollars to acquire 30% of the equity interest of Malting Company. So what did they do? They actually acquired 30% shares in Malting Company, and how did they pay the consideration? They paid the consideration through the cash. This was a cash, and with the loan notes of nominal value this, sorry, market value this, to acquire 30% of the equity interest of Malting Company. The remaining 70% in Malting is owned equally between two unrelated companies. So unrelated companies means they're not connected to each other and they're not taking the decisions together. That's what the unrelated company is gonna be. Now it says all key operating decisions require unanimous consent of all three investing parties. When you talk about unanimous means everybody should agree. So when everybody should agree, that means it's a joint control. Each of the three investing parties has the right to its share of the net assets of Malting via contractual agreement. So you have a right to your right of the net assets. So 30% right belongs to you. Malting reported a loss of 0.8 million for the year ended 31st March 9, and a dividend was neither paid nor proposed. So no dividend was there. All three investing parties provided separate guarantees to Malting Company's bank because Malting Company's poor performance in the year. So that is because of the Malting Company's poor performance in the year. Now, what was the requirement of the question? The requirement of the question was that you had to use the exhibit number 2, and while using the exhibit number 2, you had to actually suggest the accounting for. You actually have to suggest the accounting for this malting company, that what exactly is going to be the accounting for the malting company. That's what you have to suggest. Now let's just start discussing about this. So the first concept that you people need to understand is the concept of IFRS 11, which discusses about the joint arrangements. So the first thing that I'm going to talk about is I'm going to talk about IFRS 11, which is joint arrangements. Now what is this IFRS 11 joint arrangements all about? When we talk about IFRS 11 says that the joint arrangements are usually of three types. What are those three types of joint arrangements? And it also suggests the accounting for all those three types also. One of them is called a jointly controlled asset. The other one of them is called jointly controlled operations, and the third one of them is called jointly controlled entity. So we've got three joint arrangements. One of them is a jointly controlled asset. The second one of them is a jointly controlled operations. The third one of them is a jointly controlled entity. Now let's start discussing about it. When we talk about this jointly controlled asset, I repeat, when we talk about the jointly controlled asset, what is this jointly controlled asset all about? The concept of jointly controlled asset is that whenever there is an asset which is jointly owned by two or more people, owned so that is actually going to be considered as a jointly controlled asset. A lot of things happen, like for example, huge cranes, excavators, drilling equipments, etc. Things like that. Usually majority of this happens with respect to earth moving equipments. They're generally very expensive and not a single party can have majority use of that. So generally a lot of companies, they purchase those earth moving equipments in combination with each other, or could happen with other things also, but generally jointly controlled asset is an asset where two or more parties, they own an asset and they jointly decide about that asset, that how exactly is that asset going to be used. So whenever you have got a jointly controlled asset, how do we account for the jointly controlled asset? The accounting for jointly controlled asset is like this. Each investor to recognize share of jointly controlled asset in its financial statement. So what happens is that when we talk about a jointly controlled asset, the accounting for a jointly controlled asset is that each of the investor have to recognize their share of asset in their financial statement. So I repeat, each of the investors have to recognize a share of jointly controlled asset in their financial statements. Okay, now you see what happens is that there is a question that's being asked that when we talk about a jointly controlled, so do we need to have equal ownership? The answer is no. Equal ownership is not the necessity. What is necessity is that no single party could take a decision, no single party has a control. It's a joint control of all the parties, so that's considered to be a joint control. Like no one can decide in isolation, or no single person could be left in isolation. So it should be like every single person should be consulted and every single person should be actually together. That's how it is going to be, right? Okay, now the next one of them is a jointly controlled operations. What is this jointly controlled operation? When we talk about jointly controlled operation, the concept of jointly controlled operation is that let's say when we talk about operations is a proper business that's taking place. Like sales are taking place, purchases are taking place, expenses are being incurred, the assets are being purchased, liabilities are being incurred, etc., etc. So like proper operations are taking place. That's what an operations is considered to be. So if you have got any activity which two or more parties they control, if you've got any activity which two or more parties control, so that is going to be considered as a jointly controlled operations. Generally happens with respect to the construction of, let's say, um, buildings, highways, things like that. That with respect to buildings, with respect to highways, everything, what generally happens is that this is how things actually go about. I repeat, so when I talk about the jointly controlled operations, this is how things go about, right? Now let's move and let's discuss a bit further. When you have got a jointly controlled operation, how would you account for it? So under the jointly controlled operation, each partner has to account for their share of asset, liability, income, expenses. So like for example, let's try to understand this thing. For example, if you have got, let's say, 35% share of operations. So what happens is that when you're going to be when you're going to be preparing your financial statements, so in the sales, you would say your own sales plus 35% multiplied by the sales of the other company. Your own cost of goods sold plus 35% of the other company's cost of goods sold, things like that. That is something that you would have to do. So that's how things go about. So you account for these all in your financial statements, right? So every single item which is asset, liability, income, expenses, every single thing has to be added up like this. What we generally say is that we call it a proportionate consolidation. I repeat, we call it a proportionate consolidation, right? What do we say? We call it a proportionate consolidation, right? Now let's move a bit forward and let's take things further. The third one of them is called a jointly controlled entity. Now what is this jointly controlled entity? So everything is the same. It's simply when you have got a jointly controlled operations and you convert them into a separate legal entity. If you have got operations and you convert them into a separate legal entity, that is going to become a jointly controlled entity. What is it going to become? It's actually going to become a jointly controlled entity. So this jointly controlled entity is also termed as joint venture. I bet this jointly controlled entity is also termed as joint venture, right? What is it going to be termed as? It is going to be termed as joint venture. Now what happens with respect to joint venture is that the joint venture is accounted for in the same manner as an associate. So the IAS 28, which is now termed as associates and joint venture, actually gives you the accounting for joint venture. And under this, what are you simply gonna do? You're gonna simply account for it using the equity method of accounting. You're going to simply account for it using the equity method of accounting, right? What is it? You're going to simply account for it using the equity method of accounting. Now let's move a bit forward and let's discuss a bit further. So I've told you that what a joint venture, jointly controlled entity is going to be and how you would account for it. Now the scenario is that how exactly are you going to account for it? So with respect to the separate financial statement, there's something called separate financial statement. There's something called consolidated financial statement. Now, with respect to separate and consolidated financial statement, what is it that you need to understand? You need to understand one thing. The separate financial statements, what you need to do is that you can account for it using cost. You can record it as at fair value through P&L. You could record it as at fair value through OCI. You could record it using the equity method of accounting. There could be different methods that you could adapt in order to account for in the separate financial statements, right? With a consolidated financial statement, there is only one way to record, and that is the equity method of accounting. That's it. So there is only one way of accounting, and that is equity method of accounting. That's what you have to do with respect to the consolidated financial statement. So if I talk about this specific scenario, where we talk about the IFRS 11 joint arrangements, so this is something that you would have to keep in your mind. I repeat, this is something that you would have to keep in your mind. Now let's just start discussing about this scenario. Let's just go through it. Let's just try to look at it. Okay, Malik Aman, what we are up to is that we are doing the examination questions. And my objective is that I'll go through the examination questions on different topics, including consolidation, including the other areas like different accounting standards. That's what the agenda for the session of today is. Okay, so let's just start discussing. It says investment in malting company. So the investment in malting company, we have to, the requirement of the question is, okay, let's just start discussing about this scenario. Investment in malting company, that's something that you have to talk about. Your year end is 31st March 2000 X9 and you have acquired it on 1st July X8. You have paid cash of 2.5 million and issued loan notes with a nominal value of so and so, so and so. Okay. The investment in malting company, joint venture, accounted using equity method of accounting. Investment in joint venture. Cost of investment, cash paid, fair value of loan notes issued, 2.5 million, 1.3 million, 3.8 million, add share of post acquisition reserves. So 30% multiply by bracket open. Malting reported a loss of 0.8 million for the year ending 31st March 2009. Okay, so 0.80 million multiply by you have this investment from 1st July. That means April, May, June, 3 months out. Multiply 9 divided by 12. And in fact, it's actually a loss. So it is simply gonna be like this. नहीं सब सही है. It is simply gonna be like this. 0.18 million is the loss, that is your share. So if 0.18 million is your share of loss, ultimately what's gonna happen is that ultimately it's gonna be 3.62 as an investment in associate, as an investment in joint venture. So the investment in malting company, you would, when you would be discussing it, you would be actually giving a bit of a background. You'll not just go about doing the scenario. You'll be giving a bit of a background also. The first thing that you have to do is that you have to understand this thing, that the investment in malting company of 30% gives a joint control over malting company as the owners of other 70% are unrelated and all the decisions require unanimous agreement between the parties. The under the IFRS 11 joint arrangements, since the investment is in an incorporated entity, therefore malting company shall be considered as a joint venture and should be accounted for using equity method of accounting in the consolidated financial statements. The carrying amount of malting company for the consolidated financial statements shall be 3.62 million as per the spreadsheet. With respect to the separate financial statements of a Sterling company, the entity has a choice of recording the investment at either of the cost or at fair value through profit and loss, or as at fair value through other comprehensive income, or using equity method. In case if equity method is adopted, the carrying amount shall be the same for the consolidated and separate financial statements. In all other cases, the carrying amount shall be different for both individual and separate financial statement. Sorry, for the separate and consolidated financial statements. Okay, so let me just zoom it out for you people so that you could have a look at it. Yeah, is everyone okay till now? Any questions on this, please? Okay, lovely. I hope that the screen is not blurred anymore now, right? The screen is clear now? It's not clear. It's not clear. Okay. Okay, does it get better now? Okay, what I have actually done now is that I've actually stopped the YouTube stream just to make sure that because I could understand that probably it was getting a bit blur over here, uh, probably because the bandwidth was being consumed there too. So I think that it should be clear over here now. Okay, lovely. Thank you. Okay, now next is batch company. So I would allow you people to take 5 minutes and try to do this batch company scenario, and then we're going to take things forward. So let me just open up the batch company, the third scenario. Just give it a try for 5 minutes and then we're going to start discussing. Okay. See, I'll just repeat it again with respect to this batch company. So we have actually gone through the scenario of the batch company and we know this thing that a batch company is a separate major line of business for you as an entity. And what you have decided is that you're going to dispose it off during the year. So whenever we decide to dispose of a company, we classify it as held for sale. And when there is a subsidiary, so a subsidiary is considered to be a disposal group. Disposal group. It's a group of asset or associated liability that are going to be disposed of in a single transaction. So basically, when we talk about the subsidiary, what we do is that there is a certain accounting that you need to follow, and that accounting is like this. So under the IFRS 5, a discontinued operation is actually a disposal group. Upon classification as held for sale, you got to remeasure all the net assets at the lower of carrying amount or fair value less cost to sell. The 70% investment makes this company a subsidiary, the batch company. The goodwill should be part of the net assets upon classification as held for sale. Now see, upon classification as held for sale, you have to compare You have to compare the carrying amount of net assets with the fair value of fair value less cost to sell. And if there is any impairment loss, it should be, allocated to the disposal group using IAS 36. And when we talk about IAS 36, what does it mean? First thing has to be goodwill. The second thing has to be remaining assets on a pro rata basis. The second thing has to be the remaining assets on a pro rata basis, right? What is it going to be? The remaining assets on a pro rata basis. So let's start discussing about this scenario. This is what the whole situation is. And we're going to talk about the whole situation like this because our requirement is we have to, using the exhibit 3, explain to the directors of a sterling company how to account for batch company as a discontinued operation at 1st January X9 in sterling company's consolidated financial statement. Your answer should include a calculation of goodwill, which we'll do, and a calculation of our investment should be measured prior to disposal. Investment in batch company. The first thing that you have to do is that you have to establish the goodwill calculations, the cost of investment, fair value of NCI, fair value of net assets. The cost of investment was 3.1 million. For the fair value of net assets, the share capital was 0.5 million. The retained earnings was 2.1 million. Fair value of building 1 million was the fair value of the building. The fair value of the NCI was 0.9 million. Resultingly, the goodwill that we had was 0.4 million. The goodwill at acquisition was 0.4 million. The goodwill at acquisition was 0.4 million. Right? The goodwill at acquisition was 0.4 million. What else is there? Um, need to establish if there is any impairment at the date of classification as held for sale. So what is it that you need to do? You need to establish if there is any specific, you need to measure till the date of classification as held for sale. So basically what happens is that we are being told that that the fair value less cost to sell was 4.4 million. So when it is 4.4 million, so you would say that um, the carrying amount needs to be established. Carrying amount of discontinued operation. The carrying amount of discontinued operation would include what? This is 2.9. Share capital. This is retained earnings. This is fair value of building. You would say excess depreciation on building. How would we go about having the excess depreciation? 1st January 7, 1st January 9. So 1 year is 1st January X8, second year is 1st January X9, and it's going to be 1 million divided by 10 multiplied by 2. 1 million divided by 10 multiplied by 2. So this is what it is going to be. Uh-huh. 0.2 million, right? You add goodwill to it. So you would say the carrying amount of the discontinued operation is going to be like this. The carrying amount of discontinued operation is going to be like this, less Fair value less cost to sell, 4.4 million. Impairment loss is gonna be this minus this. The allocation of impairment loss shall be to the goodwill. So what would happen is that the impairment loss shall be allocated to the goodwill, right? Impairment loss shall be allocated to the goodwill. Now, if I talk about how exactly are we gonna explain all this? Accounting for batch company. I'll just give you the key pointers since batch is a discontinued operation. It should be classified as held for sale. For classification as held for sale should be measured at the lower of carrying amount or fair value less cost to sell. For classification as held for sale, it should be measured at the lower of carrying amount or fair value less cost to sell. The goodwill at acquisition date was 0.4 million. The carrying amount adjusted for the fair value adjustment and the excess depreciation before the classification is 4.6 million. Fair value less cost to sell is 4.4 million. An impairment loss of 0.2 million shall arise. The impairment loss is to be recognized in the P&L and allocated to the goodwill. I've not written down a long answer. I've just written down the pointers for you people to get an idea that, okay, this is how you have to do it. Right? That's what I have done. So we are done with this specific question, the name of which was Sterling Company. We've completed the question, and I hope that this is clear to you people now, the question, the scenario. Okay guys, so we are now going to start off with the next question, and the name of the question is Luna Company. The name of the question is Luna Company. Before I go on to start discussing about this question, let me just take you through. Again, this is one of the past examination question. There are multiple requirements that are part and parcel of the question. So before I go on to discuss this, let's have a bit of a background. It says Luna Company. What does it say? It says Luna Company is the parent company of a group that operates in pharmaceutical industry. All entities in the group have financial year ended 31st March. So your year end is 31st March. The current year end is 31st March 2000 X6. So what's the current year end? It's 31st March X6. The following exhibits available below provide information relevant to the question. So there is a information relevant to the question that's being provided in the below exhibits. So it says sale of shares. Sale of shares in a Starlight company provides information regarding a disposal of shares by Luna and Starlight during year ended so and so. Okay, so you have a disposal of shares. Sale of goods to a Starlight company provides information relating to a sale of goods between Luna and Starlight shortly before the reporting date. Reporting date is your year end. Rocket company provides information about creation of Rocket, including details of sale of property from Luna to Rocket. Eclipse company provides information about the acquisition of Eclipse company. The information should be used to answer the question requirement within your chosen response option. So now it's one of the recent examination questions, and this has got multiple aspects. Is a disposal, there's an intra-group transaction, there is a setting up of a subsidiary and the sale to that subsidiary, or setting up of a company, I would rather say. And then there is this acquisition of Eclipse company. If I could just go on to discuss about the requirements of this question. So there are these multiple requirements to the question. What are these? First, it says explain with calculations how the disposal of shares in a Starlight should be accounted for in consolidated financials of Luna Group for year ended. So one of them is a disposal of a shares. That's what the scenario is. Second, it says discuss the principles that should be considered by Luna in recording sale of goods to Starlight companies Luna's individual financial statements for year ended so and so, so and so. Now repeat. See, a very important focus is here on individual financial statement, right? For the year ended 31st March X6, conclude on whether the accounting treatment currently adopted is correct. Conclude on whether the accounting treatment currently adopted is correct. So you have to conclude on the current accounting treatment also. Then it says using exhibits 1 and 2 only, present extracts that should be included in the consolidated statement of profit or loss for the year ended 31st March X6. Your answer should include revenue, okay, cost of sale, okay, and profit of a Starlight attributed to NCI. Then another requirement, discuss with calculations how investment in Rocket should be accounted for and how the sale of property should be accounted for. Discuss whether acquisition of Eclipse should be treated as a business combination in accordance with IFRS 3. Your answer should consider whether skills and experience of team of scientists can be recognized as separate identifiable assets. So there are multiple scenarios, multiple situations that we have to discuss with respect to this question. Let's just start discussing about each one of them. Let's take things through. So the first one of them is the sale of shares in a Starlight company. There's something which is called a Starlight company, right? I bet there's something which is called a Starlight company. So the first scenario with respect to Starlight company is Luna acquired 80% interest in a Starlight company on 1st April X2. X2, right? What financial year are we talking about? Let's just go back, 31st March X6. Okay. So X2 is when you acquired the shares. Starlight had an issue 1 million equity shares and has not issued any shares for many years. So they have not issued any shares for many years. Goodwill was calculated as this, but had subsequently been impaired by this. In 2004, Luna's values the NCI at fair value of net assets at acquisition exceeded their carrying amount by 200,000. The fair value of net assets exceeded their carrying amount by 200,000. This all related to non-depreciable land which is still owned and so on so on. At 1st January X6, Luna sold 100,000 equity shares. So if it's 1 million share, it's simply 10% disposal. For a $7 per share, the only reserve within the equity within the individual financial statement is retained earnings. Balance of this reserve at 1st April X5 was this. Starlight Company generated a profit for the year ended 31st March X6 of this, which accrued evenly throughout the year. Now see, so there is something that I want to explain to you people with respect to this, which is disposal of subsidiary. Disposal of subsidiary. There are multiple scenarios, and amongst the multiple scenario, one of the scenarios could be the multiple scenarios, and amongst the multiple scenarios, one of them could be control lost, and the other one of them could be the control retained. Now, what could be the situations? It could be like this. You had a 80% subsidiary, it turns into a 0%. You had a 80% subsidiary, it might go on to become 30% as an associate. And when we talk about the control retained, so you had a 80% subsidiary, it may go on to become 65%. That's when you would say that it's actually control retained, right? You would say that it is control retained. So let me just guide you people a bit. There is a control retained, there is a control lost. Both of the situations are actually there. Now try to see the things. Let's try to understand the situation. Here is the scenario where the control has been retained. So I'm just going to guide you through that. How would we go about with this control retained situation? Whenever you have got a control retained, whenever you have a control retained, what is it that you need to do? You just have to make sure that a gain or loss on disposal shall be calculated. This shall be recognized within equity. So a gain or loss on disposal shall be calculated and it should be recognized within the equity, right? That's what you have to do. How exactly do we establish the gain or loss? So we simply do it like this. Let's say you're at a 80% shareholding and you have now reached 60% shareholding. So what are you simply gonna do? You're simply gonna say that, okay, consideration received, whatever the amount is, And then what you need to do is that after you have got the consideration received, what is it that you need to do? You need to compare it with less carrying amount of net assets. Sorry, disposed. Now let's try to understand this. Let's say, for example, this is 100 million. That's the consideration received. The net assets that you disposed of were 78 million. Hence, 22 million is gonna be your gain. 22 million is gonna be the gain on disposal. Okay, is it the problem with everyone that you cannot see what I'm writing? But is it the problem with everyone that you cannot see what I'm writing? Okay, is it okay now? Okay, thank you. Sorry about that. Thanks for identifying on time. Now, so what are you going to do? You're simply going to do it like this. You would say cash debit by 100 million. You would say cash debit by 100 million. The NCI credit by 78 million, because when you dispose of what increases is NCI. And then you would say equity credited by 22 million. And then what you do is that you say the equity is going to be credited by 22 million, right? The equity is going to be credited by 22 million. Now, let's just start applying the same to this specific scenario and see what is actually going to happen. So let's try to apply this to the scenario and see. Okay, So we would say that disposal of investment as at 1st January 2006. The disposal of investment as at 1st January 2006. Disposal proceeds 100,000 into 7 less the fair value of net assets disposed. So you've got the goodwill, which was 320,000. Share capital is 1 million. The goodwill is 320,000 into 85% because it was impaired by 15%. Right? So goodwill is 272,000. The share capital is 1 million. Retained earnings at 1st April x5. The retained earnings at 1st April x5 is 4658,000. Profit till 31st or profit till 1st January is actually what? You had 165,056 which accrued evenly, and your year end is 31st March, right? So 9 months profit needs to be added up. Hence, this is something that you have to add up, right? So resultingly, what happens is that this is cumulatively coming out to be 6053,792. There was this fair value adjustment of land at acquisition, 200,000. Right now, percentage disposed is 10%. Now, what is actually going to happen is that you would simply look at it like this. Hence 74,621, and this is going to be considered as gain on disposal. 74,621, and this is going to be considered as gain on disposal. What is it going to be considered as? Gain on disposal. So what are you actually going to do? You're going to try to understand this thing, that the accounting treatment shall be as under. Let me just look at the scenario. What is he asking? Okay. Starlight Company. Sorry. Luna. The first part is about, huh? नहीं नहीं बेटा कुछ भी. Starlight Company. The disposal of the disposal of 100,000 shares is equal to a disposal of 10% shares in a Starlight Company. The remaining shareholding after the disposal is 70%, and hence the control is not lost. A gain/loss on disposal is required to be established, being the difference between the fair value of the consideration received and the carrying amount of the net assets transferred to NCI through the sale transaction. The calculations lead to a gain of 74,621 as per the spreadsheet. This gain, the resulting gain shall be recognized within the equity, leading to enhancement of the reserves. An increase of 625,379 shall be recognized within the non-controlling interest. Right? That's what you would have to do, right? That's what you would have to do. Okay, why NCI was not added? Because we are considering 100%. NCI was at fair value, and plus we are considering the 100% of the business's assets, which includes the goodwill 100%, which includes the 100% net assets. So NCI is only considered in the calculation when there is a proportionate goodwill. Okay, so this is what you would do with respect to this part. Now let's move a bit forward and let's discuss the other part of the question. The next part that you have is about this scenario, which is sale of goods to Starlight Company. Sale of goods to Starlight Company. Yeah, take 3-4 minutes, try to go through it, then we are going to start discussing. Take 3-4 minutes, try to do it, and then we are going to start discussing. Okay, let's just start off. So, okay, let's just start off with this scenario. It says on 20th March 2006, the year end you disposed of on 1st January 6th, 10% shareholding. It says on 20th March 2006, Luna sold 5,000 units to Starlight. Luna is who? Luna is the parent entity. Now, what did the parent do? Parent sold to the subsidiary at an initial transaction price of 200 per unit, and control of the goods passed from Luna to Starlight on that date. So Luna sold that, and the control of the goods passed from Luna to Starlight at that date. Payment is only due when Starlight sells the goods onto the end consumer, which typically takes around 6 months. Starlight Company had not yet sold any goods onto the final consumers as 31st March 2006. So basically, you sold the goods to Starlight. Starlight is not going to make payment till the time they sell the goods ahead. The goods have a high risk of obsolescence, and therefore price concessions are regularly granted in order that the goods can be easily transferred on within the distribution channel. On the basis of past practice, Luna anticipates that it will grant Starlight a price concession of between 8% and 38%. Current market data suggests that a maximum price concession of 35% may be necessary to enable Starlight to distribute the goods to final consumer. Initial cost of the goods to Luna was 80 per unit. Luna has recorded the sale at initial price of 200 per unit. Starlight has included the goods within their closing inventory at value of 1 million. Revenue and cost of sales for the respective entities for the year ended so and so are as follows. Now, what is it that we need to do? Let's just try to understand this whole scenario. Let's talk about this whole situation, that how would we go about with the things. So basically, the requirement of the question was, which I don't want you to mix up. The requirement of the question was explain the principles that should be considered in recording the sale of goods in individual financial statement, right? Now here what we have to actually discuss is, it's a IFRS 15. It's IFRS 15 revenue from contracts with customers scenario, right? What is it? It's an IFRS 15 revenue from contracts with customers scenario. That's what it is. Now let's just start discussing about this whole situation. Let's try to see how things are. Basically, when we talk about the IFRS 15, there are multiple aspects to the question, and always remember that when such type of scenarios come, just don't start mentioning about the 5 step to revenue recognition. That's not what is needed. They want you to tell them the accounting, right? Just talk about the relevant accounting aspect. Don't talk about here and there things. Just talk about what makes sense. Just talk about the relevant items. So basically, one of the thing is that number one is that recognition of revenue. And the second thing is the transaction price. These are the two main scenarios, these are the two main situations with respect to this specific question. There is nothing else. Now, with respect to recognition of revenue, it's a transfer of goods, right? So you got to recognize when risk and rewards are transferred. Irrespective of when they are sold, the risk and rewards are transferred upon transfer of goods, right? You got to recognize when risk and rewards are transferred, irrespective of when they are sold, the risk and rewards are transferred to Starlight upon transfer of goods. That's something that you have to understand. Now, the second thing is that in the current situation, in the current situation, control of goods passed upon delivery, hence revenue shall be recognized upon the delivery of goods. That's something that you would have to do. You have to recognize the revenue upon the delivery of the goods. That's something that should happen. Recognize the revenue upon the delivery of the goods. Right? Now let's move a bit forward. The transaction price could include both fixed, variable consideration. In this scenario, concessions have been involved. Hence, the concessions have been involved. Hence, the concessions have been involved, right? So the prices, what should happen with respect to the prices is that should include the estimated concessions that may be granted, right? Now, what else is there? Uh, Either use the expected value method, or you use, I repeat, either you use the expected value method or you use the best estimate. Here, an average could be used since sufficient information is not available. So 8% plus 38% divide by 2. 23%. However, while using variable consideration, ensure that revenue recognized shall not be ensure that revenue shall only be recognized if it is unlikely to be reversed, right? If it is unlikely to be reversed. You just have to make sure that the revenue shall only be recognized if it is unlikely to be reversed. So based on past trend, 35% concession is highly likely, right? So I repeat, based on past trend, the 35% concession is highly likely. So what you should do is that sale should be recognized at 200 into 65%. Why 65%? Because you're expecting 35% concession, multiply by 5,000 units. 6.5 million, right? Or am I doing something wrong? 200 into 65% into 5,000. Okay, sorry about it. I've done something. I've just put an extra zero. 650,000 needs to be the amount of revenue. That's what you should be doing in the individual separate financial statement, right? Kindly look at it so that we could move forward then. Yeah, kindly look at it, and just in case if any one of you have got anything to ask with respect to it, you're most welcome to ask. Okay, let's move a bit forward and let's discuss about the next aspect, Rocket Company. So here you go, take 5 minutes for Rocket Company. Take 5 minutes for this Rocket Company. Okay, so let's just start off and let's just start discussing about this. It says Rocket Company on 1st April 4, Luna Company and unconnected third party established a joint arrangement. What did they do? They established a joint arrangement involving the creation of a joint venture called Rocket Company. Each venturer paid $6 million in cash to the newly created entity Rocket Company in exchange for a 50% investment in interest in equity share. So your investment is 50%, right? Now, Rocket has earned profits for the year of 73,450 and 126,980 in the years ended 1st March 2005 and 2006. Additionally, Rocket Company paid dividends to both Luna Company and other venturer of 15,000 each in the current year. So they've paid dividends in the current year also of 15,000 each, right? Now what next is there? Then it says that this was the first time dividends had been paid by Rocket Company. So Rocket Company had actually paid the dividend and this was the first time that this has actually happened. Now what next is there? The next situation is that it says this was the first time so and so so and so on 31st March 2006, Luna transferred a property to Rocket for proceeds of $8 million, which is agreed to be equal to the market value of the property on that date. The carrying amount of the property in the financial statement of Luna was $10 million. Now, what do we need to do? We need to account for the Rocket Company. Do you have any suggestions as to how the Rocket Company should be accounted for? What is the requirement of the question? Discuss with calculations how you got to discuss with calculations. What do you need to do? Just a minute, please. Sorry. Okay, so let's actually start discussing about it. It says discuss how the calculations in Rocket Company should be accounted for. Now, what I'm actually going to do is that I'm going to talk about few things, which is number one, 50% is stake, separate legal entity. It is actually a joint venture, should be equity accounted for, shown as single line item in financial statement for the SOCI. Only share of profit to be shown. Now, what is actually going to happen is that the investment in joint venture to be shown as follows. Um, it would be like this. It would be the cost of investment, which is $6 million. I would rather write this $6 million like this. Share of post-acquisition profits. So we know that they have actually earned profit of this much, earned profit of this much, paid a dividend of 15,000 each in the current year, each, like two people. So two dividends are there. 50% multiplied by, since it was newly established, so 73, 450 plus 126, 980 minus 2 into 15,000, right? So it is actually gonna be 85,215. Hence, the carrying amount of investment shall be 6085,215. 6085,215. So this is how you would account for this investment in an associate, right? Is it? This is how you will account for this investment in joint venture, sorry. Now, the next situation is there is a property transferred also, which we need to understand. Now, you would say that joint venture, it says each venturer paid. Is it not each venturer? It's each venturer paid, right? Well, it's MICA code, it's IS 28, not IFRS 28. Okay, now next situation is basically, let's move a bit forward. So with respect to this property transaction, with respect to the property transaction, what's happening is that JV is not consolidated. If any transaction is undertaken, then own share of profit slash losses cannot be recognized. Furthermore, you got to understand few more things, which is that However, if there is any indication of impairment, then such loss shall be recognized. Carrying amount was $10 million. Fair value, or rather you would say the market value was $8 million, right? Hence, an impairment loss of $2 million shall be recognized, right? An impairment loss of $2 million shall be recognized. That's something that you have to do. So here, although this Luna transferred the property, but the property actually had a market value of 8 million and there is 10 million. So the 2 million has to be written down. The 2 million needs to be written down, right? Okay. Now last part of the question, which is about Eclipse company. The requirement is discuss whether the acquisition of Eclipse company should be treated as business combination in accordance with IFRS 3. Your answer should consider whether skills and expertise of scientist team can be recognized as separate identifiable assets. So you have to talk about this number 4, whether this should be considered as a business combination or not. Okay, let's just try to see what's happening with respect to this Eclipse company. It says Eclipse is an entity which has a sole purpose of producing a new medicine to fight various diseases, having secured a license to do so following successful initial trials. So they secured a license and they're actually producing a new medicine. Eclipse companies consist of highly skilled team of scientists. There is also a small support team under contract who carry out various administrative and accounting functions. Clinical tests undertaken by the team of scientists have been extremely encouraging, and it is expected that the medicine will be on the market sometime within the next year. On March 31st March 6, Luna acquired 100% of Eclipse. It also decided that it would be important to retain the contract of the team of scientists. as there was considerable specialized knowledge and so and so. Only asset recognized in individual financials is a license to manufacture. However, Luna estimated it's worth paying extra 1.5 million consideration in order to secure the skills and experiences of the team of scientists, right? So the question is that should it be a business combination or should it not be a business combination in accordance with IFRS 3? Now, first thing is that let me just try to help you people understand this, that what exactly is this business combination scenario all about in this situation. See, what happens is that the IFRS 3 is only applicable to business combination. I repeat, IFRS 3 is only applicable to business combinations. Now, when I talk about the IFRS 3 being applicable to business combinations, just try to understand something, which is when we talk about the IFRS 3 business combinations, you need to understand that um, at times you acquire an asset and at times you acquire a business. So if you have actually acquired an asset, if you have acquired an asset, then IFRS 3 is not applicable. But if you have acquired a business, IFRS 3 is applicable. Now, when we talk about acquiring a business, just try to understand something. Basically, what is a business? A business is basically something that is made up of input and output. There have to be processes involved. Should be capable of generating sales. Output at the time of acquisition is not always necessary. So, although they are not producing any asset, but license is obtained, research is being undertaken, hence this is a business. IFRS 3 should apply, right? You get it? So IFRS 3 should apply. Okay, good enough. So we are now done with this specific question, the name of which was Luna Company. And I hope that this question would have actually been easy for you now after going through the whole discussion that we did while doing this session. So just in case if you have got any questions up till now with respect to this Luna or anything, do let me know before I proceed. Yeah, do let me know, please.